So one obvious question here is, why can't we just use the fair value method when investor has significant influence over investee? Why do we need to use another method? And please take 1 minute, try to think about this question, and you can pause your video for now. So why can't we just use the fair value method when investor has significant influence over investee? If you think about it, when investor has significant influence over investee, what exactly does it mean? It means that investor may be able to influence investee's dividend policy, right? So under the fair value method, what do we do when investee declares dividend? Investor report it as dividend revenue. So which means that if investor is able to influence investee's dividend policy, it may be able to manipulate its own earnings. So it may potentially manipulate its dividend revenue by influence the amount of dividend paid by investee. And we cannot let this happen. So that's why when investor has significant influence over investee, we need to use another method. And then we choose to use the equity method. And equity method can limit this potential way of manipulate dividend revenue. So that's why we need to use another method when investor has significant influence over investee. So the specific journal entries here under the equity method, when investor purchase those equity securities, the journal entry is the same as under fair value through net income method. We debit investment in the stock and credit cash. And when investee earns and reports income, we debit investment account and credit investment revenue. So that is when we increase our revenue. When investor receives dividend, so here we debit cash because we receive cash dividend, and we credit investment account. So this decrease our investment account. And when investor sells this equity security, we debit cash and we write off all of the account that is related to this equity investment. So we credit investment in the stock. And depending on whether this equity security is sold at gain or loss, if it is sold at gain, we credit gain on sale of the investment. And if it is sold at a loss, we debit loss on sale of the investment. So this is the journal entries. And just pay attention here that we don't need to worry about the change in fair value here under the equity method. So change in fair value is not relevant here. We don't need to record any fair value adjustment here. Now let's look at an example. So still the previous example, under the second situation, company A purchased 30% of company B stock. And then here we need to use the equity method. Under the equity method, the purchase of the stock on January 1st, that is the same as fair value through net income method. And then on December 31st, we need to recognize company A. So now company B report net income of 500,000, and company A needs to report it as its investment revenue as well. So when company B, when investee reports earnings, company A needs to increase its investment account at the same time increase its investment revenue. So here, because company A owns 30% of company B, so company A kind of have 30% of the share of company B's net income, and that is 150,000. So we debit investment in company B stock for 150,000 and credit investment account investment revenue for 150,000. And then when company B paid out dividend, so here company A shares 30% of that dividend. The total dividend paid is 750,000. And 30% of that is 225,000. So when company B pays out dividend under the equity method, that is viewed as a decrease in the investment account. So we debit cash 225,000 and credit investment in company B stock 225,000. And then under the equity method, we don't need to worry about the change in fair value. And when company A sold the stock, we don't need to adjust the fair value neither. But the journal entry is to debit cash 1.446 thousand. And we need to write off the balance of the investment account regarding company A's holding of company B stock. So the investment in company B stock, the balance is the original cost is 1.5 million. And then we debited 150,000. That is company A's share of company B net income. So plus 150,000. And then we take away 225,000. That is the dividend. So the balance at the time of sale is 1.425 million. So we need to write off all of the balance. And now you can see that this journal entry doesn't balance. The imbalance is at the credit side of 21,000. So in other words, the book value of the investment is 1.425 million. And we're selling it for 1.446 million. So we're selling it at a gain. So we credit gain on sale of investment. So that is the journal entry under the equity method.